Here's the financial reality everyone needs to understand right now. Silver just crashed 17%. Let that number sink in. 17% in a single trading session. During Asian hours, silver plunged all the way towards $73 an ounce before trimming losses to around 11% by mid-morning in Europe. That two-day rebound that gave people hope the worst was over, completely erased. We're now down more than one-third from last week's all-time high above $120. Gold is sliding another 3.5% in extremely volatile trading. Copper is slipping below $13,000 a ton. The entire precious metals complex is under heavy pressure. Before we go further, I need to be completely transparent with you. I'm only on YouTube and X, formerly Twitter, under the name Financial Crux. I don't sell courses, signals, mentorships, or any paid products. If anyone contacts you claiming to be me and trying to sell something, block them immediately. They're scammers exploiting this community. I share this analysis for free because so many of you tell me it helps you cut through the noise, understand what's really happening, and make better decisions in these chaotic markets. If you want real-time updates and to connect with serious investors tracking this together, join our WhatsApp community. The link is in the description. And follow us on X at Financial Crux for fast updates when markets move like they are right now. Now let me break down what just happened and why it matters. Drop a comment. Where are you watching from? What country? What city? And tell me what you're doing with your silver right now. Are you holding, buying the dip, selling, or did you get stopped out? I want to hear your real experience. Now connect today's crash with what we've been tracking for weeks. Silver exploded above $120 last month in a historic rally. Premiums in Shanghai surged as high as 40% above COMEX prices. Dealers were struggling to source physical metal. Momentum looked unstoppable. Silver suffered the largest single-day crash in its entire history. Gold posted its steepest drop since 2013. That was supposed to be the capitulation, the final flush. The two-day bounce that followed was supposed to mark the bottom. Today's 17% collapse tells us the selling isn't finished, the floor hasn't been found, and the volatility is far from over. Analysts at Saxo Bank put it perfectly. They said heavy selling emerged in Chinese futures markets and on the CME after silver failed to break resistance around 90.50. Until volatility falls and liquidity improves, silver is likely to continue trading violently in both directions. That's not language analysts use casually. That's a warning that we're in a market where normal rules no longer apply, where moves that should take weeks are happening in hours and volatility is feeding on itself. Here's what triggered today's collapse. After Friday's massacre, silver attempted a recovery. It bounced for 2 days. Traders believed the worst might be over. But as price approached the 90.50 level, it ran straight into a wall of resistance. Once that level held, algorithmic selling kicked in. Momentum flipped, forced liquidations accelerated, and we got another cascade, another wave of panic selling, another 17% plunge. Goldman Sachs released analysis that every silver investor should understand clearly. They warned that extremely thin inventories have created squeeze-like conditions. When buying pressure hits, there isn't enough metal available, so prices explode higher. But when selling pressure shows up, there's no depth to absorb it, so prices collapse just as fast. The same conditions that sent silver racing to $120 are the exact conditions driving it down to the low 70s. Low inventory doesn't stabilize markets. It amplifies them. There's no cushion, no buffer. Every buyer and seller now has an outsized impact on price, which is why we're seeing historic moves in both directions. And now I want to ask you, what time is it where you're watching from right now? Morning, afternoon, or the middle of the night? Drop a comment. I'm always curious to see when people are watching this content, whether you're catching it before markets open, trying to prepare, or after hours trying to make sense of what just happened. Here's something massively underreported. The turbulence in silver is making trading more difficult for the banks that dominate London's over-the-counter spot market, the market makers who provide liquidity and allow the market to function. Right now, even holding positions briefly has become too risky, and when market makers step back, liquidity dries up, which in turn drives even more volatility in a self-reinforcing loop. Volatility causes reduced exposure. Less exposure means less liquidity. Less liquidity amplifies volatility, and around it goes. Exactly why Saxo Bank warned silver will continue trading violently in both directions, as the market structure itself is broken and normal rules don't apply, so expect the unexpected until conditions normalize. Another factor getting too little attention is credit constraints. Banks allocate capital to precious metals desks, but higher prices and extreme volatility require more margin and collateral per trade, limiting the number of trades they can take, reducing liquidity further, and magnifying the impact of derivatives on the spot market with the tail wagging the dog. About 65% of viewers aren't subscribed. If this analysis helps cut through mainstream noise and shows the full picture, subscribe and join our WhatsApp community. This channel focuses on real analysis, not hype, showing both sides so you can make your own decisions. Looking at the broader picture, precious metals shattered records over the past year, fueled by central bank buying, strong ETF inflows, speculative momentum from China, geopolitical turmoil, and doubts about U.S. Fed independence, driving investors from bonds and currencies to hard assets, which held through January until President Trump nominated Kevin Warsh as Fed chair, a hawkish signal that triggered a dollar rebound, making dollar-denominated commodities like silver more expensive for overseas buyers, which sparked widespread profit-taking, amplified by leveraged positions in ETFs, futures, and options, creating cascading selling that started Friday in Asian trading and continued through this week, leaving the two-day rebound insufficient, and today's 17% crash, proving selling pressure is far from exhausted. Quick question for the community. Were you using leveraged products during the silver rally? Drop it in the comments, as millions of dollars of leveraged positions have been liquidated in the past week, a painful lesson in risk management and position sizing. The bearish case is straightforward. Silver is down more than 1/3 from last week's all-time high, which is not a normal correction, but a crash, and failed bounces, like the rejection at 90.50, often lead to lower lows. CME Group raised margin requirements, increasing the cost of holding positions and forcing more liquidations, adding selling pressure, while the strengthening dollar, up 1.3% to 97.89, further weighs on prices, showing the bottom is not yet in and that volatility is far from over.